For every 1 ounce of silver that can actually be delivered on a COMEX futures contract right now, there are 16 ounces of paper claiming to represent it. 16. That ratio is not a forecast. It is the current published data from the CME Group's own warehouse reports. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. COMEX May silver hit $63.15 today. Spot touched $67, and the registered inventory situation did not improve, it deepened. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: COMEX silver registered inventory. As of February 18, 2026, registered silver, the only silver immediately available for futures contract delivery, stands at 27.1 million troy ounces. Total open interest in COMEX silver futures represents approximately 429 million ounces of paper claims. Coverage ratio at the registered level, 6.3%. That is not a rounding error. That is a structural condition. This follows a sustained drain that began accelerating in September 2025, when registered stocks were roughly 1/3 higher than they are today. Between early and mid-January 2026 alone, 33.45 million ounces were physically withdrawn from COMEX in 7 days. 7 days. That is 26% of registered inventory removed in a single week. Industrial users pre-positioning. Institutional investors converting paper to physical delivery. Eastern buyers paying above COMEX premiums to pull metal into Asian storage. Three forces, operating simultaneously. The timing is what deserves scrutiny, not the withdrawal itself, the timing. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX registered silver was at levels this low relative to open interest. Silver moved over 300% within the following 24 months. The data is already telling you something. Let's build it out. Now let's build the full picture because this drain does not exist in a vacuum. The CME Group warehouse report, published daily, shows registered silver at 27.1 million ounces. Eligible silver, held in COMEX vaults but not yet available for futures delivery, sits at approximately 470 million ounces total. The key distinction: eligible cannot satisfy a delivery demand unless the holder reclassifies it as registered. That reclassification requires active consent. It is not automatic. It is not guaranteed. Meanwhile, the April 2026 first notice day is 7 business days away. As of the last available CME data, 1,227 contracts remain open in the April silver contract. That represents 9.6 million ounces of potential delivery demand, against a registered base of 27.1 million ounces. That is 35% of all deliverable registered silver potentially claimed by one delivery cycle. At the same time, London silver lease rates, the cost of borrowing physical silver for short-term obligations, have remained elevated throughout Q1 2026. Elevated lease rates mean physical silver is hard to source. That is not opinion. That is the market pricing difficulty of access. The rate of drain is not slowing, it is compounding. The data is doing the talking. The ones who have been called alarmists for flagging the paper-physical imbalance, they are not saying much right now. And here is what makes that picture even harder to ignore. The Shanghai Gold Exchange and Shanghai Futures Exchange operate on a physical settlement model. The SGE silver premium, the amount Eastern buyers pay above the COMEX paper price to take actual delivery of real silver bars, reached $8 per ounce above COMEX in December 2025. Shanghai markets are closed today following the Monday session chaos in Western markets. When they reopen, that premium reading is the single most important data point available. If the SGE premium holds or widens despite today's paper crash to 63.15, the physical market is telling you the paper market is the anomaly. At the same time, the DXY dollar index sits at approximately 100, and the U.S. 10-year Treasury yield hit 4.41% today, an 8-month high. Those are real macro suppressors on the paper price. High yields raise the financing cost of carrying physical silver inventory. A dollar at 100 makes silver more expensive in local currency terms for Asian buyers. Both factors delay the structural squeeze. They do not resolve it. Setups like this can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the macro variable, because this is no longer a backdrop. It is the primary variable. Here is the number most people are not discussing in the context of silver: 20%. Approximately 20% of global industrial silver demand comes from solar panel manufacturing alone. Solar panel production is running at record levels in 2026. That demand does not pause for geopolitics. It does not pause for COMEX futures volatility. It shows up at the delivery window, and it requires real metal. The US-Iran conflict has now entered its fourth week. The Strait of Hormuz, through which approximately 20% of global oil supply transits, remains effectively closed to most commercial shipping. Oil near multi-year highs means energy input costs for silver mining and refining are elevated. Higher mining costs mean primary silver supply is constrained from the production side simultaneously with the demand side acceleration. Markets are still pricing a near-term resolution of the Iran situation. The U.S. 10-year yield at 4.41% and the DXY at 100 both reflect that assumption. Look at the Strait of Hormuz shipping data and tell me what probability you put on a clean resolution in the next 30 days. When markets start repricing the reality of a prolonged energy disruption, silver reprices upward, oil reprices upward, the dollar comes under pressure from the inflation it creates. That is the historical pattern. Every time a major energy choke point has been disrupted for more than 60 days, it has not been different yet. Silver Western Spot is trading at approximately $67 to $74 following today's COMEX May flash crash to $63.15. The Shanghai premium reading, when available on reopening, will either confirm or temporarily relieve the physical paper divergence. The short-term picture is this: if the 10-year yield holds above 4.3% and the DXY holds above 99, paper silver faces continued pressure towards $60 to $60 on COMEX. If yields begin to compress below 4.2%, driven by any Iran de-escalation signal or Fed commentary, the structural physical bid re-enters aggressively and silver reclaims $75 to $80 rapidly. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower timeframes right now. I cannot tell you what silver does tomorrow. Nobody can. The macro variables are moving faster than any technical setup can price. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. First, the DXY at 100 and the 10-year yield at 4.41% are mechanically hostile to silver. Financing costs are up, and Eastern purchasing power is down in dollar terms. Second, eligible to registered reclassification by COMEX warehouse holders can temporarily refill registered stocks, absorbing April delivery pressure and removing the near-term squeeze trigger. Third, managed money is actively deleveraging silver from near-record long positioning built during the January run to 121.67, and that selling pressure has not fully cleared the market. The bull case is equally real. First, COMEX registered silver at 27.1 million ounces against 429 million ounces of paper. Open interest represents a 6.3% coverage ratio with no historical precedent for a clean resolution without significant price movement. Second, 33.45 million ounces were withdrawn from COMEX in a single 7-day window in January 2026, driven by industrial users and institutional delivery demands that have not reversed. Third, the Silver Institute projects 2026 as the 6th consecutive year of structural silver supply deficit, with solar and EV demand absorbing primary production before futures markets ever see it. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure is already built into the inventory data. The only open question is whether the April delivery window becomes the moment the paper market is forced to reconcile with what the physical market already reflects. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group Daily Warehouse Stocks Report at cmegroup.com. The Silver Institute Supply and Demand Data at silverinstitute.org. The Shanghai Gold Exchange at sge.com.cn. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.